Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, Thoughtful Money's fall conference was held online this past weekend, and I'm delighted to say that the event was a real success. That was due primarily to the amazing lineup of speakers who presented and took live audience Q&A throughout the insight-packed 10-hour day. For those of you who didn't attend, I thought you'd enjoy hearing some of the conference highlights. The day started with Lacy Hunt, former senior economist to the Federal Reserve, pointing out that we're seeing a major inconsistency between money supply and GDP, one that he believes threatens to resolve an economic underperformance and downwards corrections in asset prices.
What we have is a major inconsistency in the way in which the world has historically worked. Monetary contractions bring the economy down first and then the price level. Now we're having a reduction in inflation without the commensurate weakness in GDP, but that is only true for the United States. It's not true for the major economies outside of our country. And that historically has not been the message, nor the experience, which tells me that the risk remains that we're going to have under economic performance and more disinflation and the risk of deflation.
Stephanie Pomboy then warned of the concerning continued weakness of the consumer household, now so spent up and lent up that it's starting to buckle.
So clearly, we have reached that point where the consumer is lent up. And on the spent up side, I've been, you get punished for actually going through the details because, again, Wall Street doesn't care about it. They glom onto the headline and run away with this idea that the data is strong. But what's driving the modest increase in consumer spending is obviously all the stuff people have no choice but to buy: food, energy, housing, insurance. And so that's crowding out, not surprisingly, everything else. So if you look at discretionary spending, the things people actually can decide that they want to spend or not spend on, it's been very weak. In fact, retail sales, which is largely discretionary spending, has been negative in inflation-adjusted terms for 3 years now, and it's getting worse.
Stephanie was followed up by Fred Hickey, who's very concerned that the massive inflows of capital into generative AI may soon start diminishing in coming quarters, taking the Magnificent Seven stocks down with them and likely the markets at large.
Now, one of the reasons why AI isn't generating anything is that there really isn't anything there. We've talked about that before. There was a Wall Street Journal story just yesterday. It said, this is coming from their CIO Network Summit. The headline was, companies have had fun experimenting with AI, and now they have to show the returns. We're 2 years into this, and no one's showing any returns. So there was a VP of AI on Databricks, it's a cloud company, and he said that 90% of Gen AI experiments aren't making it out of the lab, right? And the problem is accuracy and reliability. One of the things I talked about last time, one of the benefits of Gen AI was coding. And I was certain that was something where there was real progress being made in the programming area. But there's a new survey that came out and said that those gains were not as great as first thought. In fact, in some case, when this one study found there's no productivity gains, and they're finding lots more bugs in the AI generated code. So here we are 2 years later. The spending is continuing to go up. In many cases, in Google's case, it was 91% year over year spending. Yet we're not seeing any real traction here. There's no significant monetizable benefits here, and that's a problem to hold these stocks up, and it's a problem for the market as well.
We were then treated to a discussion between Federal Reserve alumni Thomas Hoenig and Danielle DiMartino Booth, which focused on the often underappreciated economic and societal cost of faulty central planning policy.
When you monetize debt, directly or indirectly, it eventually affects something in the economy in an inflationary manner. And that's what I think is we've seen the effects of that. And I think it's redistributed wealth in this country. It's created social unrest in this country. And I think those are a high price to pay for what I call excessive accommodation beyond the immediate crisis and need.
Despite the longer-term risks mentioned by the preceding speakers, analyst Darius Dale walked viewers through his latest market forecast, which looks pretty rosy through the end of the year.
And really, since September 17th to be specifically, we no longer were in this sort of hybrid Goldilocks with deflation characteristics market regime. Our market regime nowcasting process completely pivoted us into Goldilocks, and we've been in Goldilocks ever since. And our general expectation, based on our fundamental research views, is that Goldilocks is likely to persist over the medium term.
Michael Pento also shared the latest outlook his model is forecasting, which is reflation in the short term. But he took pains to note that the current sugar high the economy is experiencing from rising liquidity shouldn't be counted on for much longer.
Well, you know, the idea that we have achieved a soft landing, I find absolutely comical. I mean, there's people out there in the mainstream financial media who are talking about the start of a new bull market. And the biggest thing that aggravates me, Adam, is that the zeitgeist of today is that growth and sustainable, viable markets come from how much stimulus a government is willing to commit. So, you know, people are saying, China, come on, let's get on with it. Let's just add trillions of dollars in stimulus. And the Federal Reserve, we need 50 basis points, not just once, but we need it multiple times. And that's where growth comes from. Growth comes from not low taxes, low interest rates, low inflation, stability in governments. It comes from how much the government is willing to spend and go into debt. Well, let me just put this to rest right now. What can governments create? They can create inflation. They can engender more debt and instability, and they can kill productivity. Those are the three things that come from stimulus. Now, you can get a temporary boost in economic activity. That's true. But in the long run, you have to lug around all this excess debt. You have to lug around stagflation, and you kill productivity. You kill the private sector. That is what government is doing in the long run.
We were then joined by Michael Lieberwitz, who expounded on where he sees bonds headed from here. Despite the recent run-up in yields in the long end of the Treasury curve, he's not that worried.
There's things that can happen that could change my mind. I'm not, I don't have blinders on. I know it's a pretty dynamic world we live in, and the economy is extremely dynamic. But right now, everything we know and what history has told us for decades tells me that inflation is working its way lower, and with it, both the long end and the short end of the curve will follow.
Continuing the focus on fixed income, Stephen Bavaria joined us to discuss why today's higher yields are making it even more attractive to invest in income-generating assets today.
What it taught me was that CEOs have incredible skin in the game, more than they probably should. But it makes me feel that I can invest in corporate America, the debt of corporate America especially, knowing that CEOs and the people that work for them are going to just do whatever it takes to keep their companies alive through thick and thin, no matter what happens. And that's essentially what I'm betting on when I'm doing credit or really solid equity and high dividend payers. You're just betting that these people are going to keep things going no matter what hits the fan in the future.
Moving on to discuss currencies, dollar milkshake theory developer Brent Johnson gave his latest outlook for the US dollar.
I think there's a lot of people who think that now that the Fed is cutting, everything is okay and the dollar is sure to fall. But you have to realize, just because the Fed is cutting does not mean the dollar will fall, because it's a relative game. The ECB is now cutting. They're probably going to cut again this week.
Right.
You know,
And China obviously is doing
and China's, they're doing a tremendous amount of stimulus. Japan has, part of the reason that the dollar was falling also was Japan had been strengthening in the end, but how long can they actually do that? And so just because the Fed is cutting doesn't necessarily mean the dollar will fall. Now, like I said at the beginning, in general, if the Fed is cutting, that's a tailwind. For all else equal, the dollar should fall on that. But we just don't live in a world where all else is equal. With all the problems going on in the Middle East, with all the problems still going on in Eastern Europe with the war with Ukraine, China's doing their biggest military drill, I think, in 2 or 3 years around Taiwan right now. There's a number of things that could make the dollar rally just on a safe haven trade.
Lyn Alden then followed Brent, focusing on investing strategies for protecting the purchasing power of your wealth from currency debasement.
We've already seen that basically, bonds with duration, treasury bonds with duration have already underperformed practically everything else you'd want to own over the past several years. And while going forward, it might not be at the same rate that we saw over this period. Like that was a pretty dramatic period of underperformance because you were starting at near zero yields. I think there's still going to be basically bleeding purchasing power versus more scarce things. When we look at the Congressional Budget Office, for example, they project no recessions in the next 10 years, and yet they still project about 20 trillion in new treasury issuance hitting the market over the next 10 years. Mm-hmm. And who buys that will vary over time. Sometimes the foreign sector, sometimes the U.S. banking sector, sometimes the U.S. non-bank sector, sometimes the central bank. It'll rotate over time, but basically that's a very large amount of supply coming to market, and they can't really afford that to be kind of like structurally retaining its purchasing power, just how levered they are. And so I think a lot of that's going to continue underperforming and the currency that it's priced in. And that basically owning scarce things, as long as they don't start too overvalued, is the key way to protect yourself.
Housing analyst Melody Wright then delivered her forecast for home prices over the coming year.
We're seeing way worse sales than normal. We're also seeing, a kind of acceleration in home price declines that are bigger than the average that you would see. And we're seeing accelerating layoffs and bankruptcies. And so what I believe will happen is that you've got that those layoffs, bankruptcies happening, and that's going to push us, and we're going to see a much larger drop in home prices than we're used to seasonally, and so throughout the end of the year.
And last, natural resources investor Rick Rule then explained why he's so bullish on commodities when looking out at the next few years, though investors need to realize it's going to be a volatile ride.
To the extent that I talk about the fact that a bull market is underway, that doesn't mean for your listeners that we're experiencing stair steps to heaven, mm-hmm. that there will be an untrammeled experience higher that won't challenge their patience, won't challenge their psychological stability. This is a volatile sector. It's a risky sector. In particular, Adam, it's a sector where people buy into narratives that require time. And when people employ a 6-month strategy to a 5-year narrative, they derail the whole strategy. Yeah. So when you ask me the question, yes, I believe that the gold price goes inevitably higher, but not straight up. I believe that gold prices close the gap in performance between the gold and the gold share prices. And in fact, I believe that the gold will outstrip it. I believe that oil is higher, that natural gas is substantially higher, that copper is higher. But I think these happen over the 5-year time frame and 10-year time frame. And the difficulty is, because I'm an enthusiastic human being, your audience hears about it and they think that it's going to happen before the next long weekend, which is not what I'm saying.
The day then ended with an hour-long Ask Anything Q&A with Thoughtful Money's crew of endorsed financial advisors. All in all, the conference was over 10 hours long and delivered a wealth of actionable insights. But don't take my word for it. Here's feedback submitted at the end of the day by the conference attendees themselves. Awesome conference. Thank you. This was fabulous. Absolutely incredible event. Very informative and with excellent subject matter experts. Well done. Thanks for all of the hard work and sleepless nights that you and your team put in to pull all this off. Now go get some rest. And if you're wishing you'd attend to the conference but for some reason didn't, don't worry. You can purchase the replay video of the entire event, all the presentations, and all the live Q&A sessions simply by going to thoughtfulmoney.com/conference. All right, and now that the conference is over, I'm hopping on a plane to join the team of financial advisors from New Harbor Financial for their upcoming one. If you're going to be anywhere near Concord, Mass. This Thursday, October 24th, come join us. I'll put the link to their event in the description below this video. Thanks again to all of you who participated in our conference, as well as to those of you who purchased the replay of it. And to everyone else, thanks so much for watching.